Hey everyone, welcome back to my channel. In today's video, we're going to explore one of the most powerful and easy to understand strategies to grow your wealth over time. It's called the all-weather portfolio strategy, inspired by approaches popularized by famed investor Ray Dalio. Don't worry, you don't need $1 million or a fancy finance degree. Even if you have just $100, you can get started on this path right away. Now, before I jump in, remember to subscribe to this channel and smash that like button if you find this content helpful. And stick around, because at the end, I'll share some must-know tips to help you adapt this strategy to your own goals. Let's get started. The all-weather strategy is designed to handle all kinds of market conditions: booms, recessions, inflation, deflation, you name it. The idea is to spread your money across different asset classes, like stocks, bonds, gold, and cash, so that no matter what happens in the economy, at least one part of your portfolio will likely be doing okay. Why is this important? Well, according to Investopedia, diversification, spreading your investments around, is one of the most reliable ways to manage risk. If you put everything into just one type of investment, say tech stocks, and they suddenly crash, your entire portfolio suffers. But if you balance your money across multiple asset types, you reduce the chance of a massive loss. Let's imagine you only have $100. How do we split that? Here's one simple version of the all-weather approach: $25 in gold, $25 in equities, stocks, $25 in long-term bonds, and $25 in money market funds or cash equivalents. That's it, 4 categories, each with 25% of your money. Why these 4? Gold, often seen as a hedge against inflation and currency fluctuations. Historically, gold tends to do well when market uncertainties or inflation rise. Equities, stocks, represents growth potential. Over the long term, stocks generally deliver higher returns than many other assets, although they can be more volatile in the short term. Long-term bonds can provide stability and income, especially when interest rates and inflation are moderate or falling. Money market funds acts as your cash buffer. They offer liquidity and protect you from needing to sell off riskier assets at a bad time. According to Ray Dalio's principles, having a balanced mix of non-correlated assets can help cushion the blow during tough times, like when stocks plummet or inflation spikes or other unpredictable events occur. So, you've put your $100 into these 4 buckets, 25% each. What's next? As time goes by, each asset will grow or shrink differently. After 1 year, you could see something like this. Gold grows from $25 to $30. Stocks, equities, grow from $25 to $35. Long-term bonds grow from $25 to $28. And money market funds grow from $25 to $27. Now your total portfolio is worth $120. That's $30 plus $35 plus $28 plus $27. But notice that the allocations aren't at 25% each anymore. Stocks have gone up more than the others, meaning it takes up a bigger slice of the pie. Here's the key step: rebalancing. You'd look at your overweight positions, like the $35 in equities, and trim it back down to $30. That frees up $5. Then you add $2 to your long-term bonds, boosting them to $30, and $3 to your money market funds, also bringing them back to $30. Gold is still $30, so everything lines up again at $30 each, which is 25% of your new total $120 portfolio. Result? You're back to an even distribution of 25% per asset class. This strategy ensures you're selling high in the asset that performed well and buying low in the assets that underperformed. It prevents any single category from dominating your portfolio and also helps lock in gains. For an official look at why rebalancing matters, check out this research paper from Vanguard, a major investment management company. This might sound almost too simple, right? But that's its superpower. An all-weather portfolio typically has these benefits: less volatility. Because you're spread out over different assets, your overall balance won't rise or fall as sharply in market swings. Steady growth. Over time, equities tend to provide growth, while bonds offer stability, gold hedges against inflation, and cash or money market funds add security. Psychological comfort. You don't panic as much during market crashes. Even if stocks tank, you know you've got bonds or gold potentially balancing it out. Easy to maintain. Just rebalance once or twice a year. It's not rocket science. You don't need to be glued to trading apps 24/7. Of course, no strategy is risk-free. You could still lose money if multiple asset classes drop at the same time. But historically, according to Morningstar data, a balanced portfolio experiences fewer devastating losses than an all-stock or all-crypto approach. Let's take a real-life example. Consider Sarah, a 30-year-old nurse who has never considered herself good with money. She decides to set up an all-weather portfolio with $10,000, $2,500 in gold, $2,500 in stocks, $2,500 in long-term bonds, and $2,500 in money market funds. Every year, she checks in on her portfolio. Sometimes stocks do great, sometimes gold shoots up, sometimes bonds hold steady. But Sarah just patiently rebalances back to 25% each time. After 10 years, Sarah notices her account has grown, with less wild ups and downs than her friends who chased hot tech stocks or cryptocurrencies. She might not have the highest returns during a massive bull market, but she also avoids panic and huge drawdowns during market crashes. She sleeps well at night knowing she's balanced. All right, let's get more practical. Here are some actionable tips for making the most of this strategy and solving common pain points. Start small and automate. You don't need thousands of dollars to begin. Platforms like Fidelity, Vanguard, or Charles Schwab allow you to invest with small amounts. Set up automatic contributions like $50 or $100 a month. That way, you're constantly adding to each bucket without even thinking about it. Pick the right funds or ETFs. For stocks, look for broad market index funds like an S&P 500 ETF. For bonds, choose long-term bond funds or diversified bond ETFs. For gold, you can buy physical gold or gold ETFs. Just be mindful of fees and storage if you opt for physical bullion. For money market funds, choose reputable, low-fee options from major providers. Watch fees. Fees can eat into your returns. Check the expense ratios on any funds or ETFs you're considering. According to Morningstar's fee research, lower-cost funds often outperform high-fee ones over the long run. Set a rebalance schedule. Some people rebalance annually, others do it every 6 months. The key is consistency. Don't over-rebalance. Once or twice a year is usually enough to keep your portfolio in check. Stay disciplined. One of the biggest pain points is emotional investing. When markets soar, we're tempted to put everything in stocks. When markets crash, we want to bail out. With an all-weather approach, you stick to your 25-25-25-25 rule. This removes the emotional guesswork. So there you have it. A super straightforward way to build an all-weather portfolio with as little as $100. By splitting your money across gold, stocks, long-term bonds, and money market funds, and then rebalancing once a year, you can help stabilize your returns and potentially enjoy a smoother ride over the long haul. If this video gave you a fresh perspective, do me a favor. Smash that like button and hit subscribe. Share this video with a friend who's always asking for easy, reliable investment tips. If you have any questions, drop them in the comments below. I love hearing from you guys. Remember, investing always carries risk, and past performance is never a guarantee of future results. If you want personalized advice, it's best to consult a licensed financial advisor. But hopefully, this all-weather breakdown shows you that wealth building doesn't have to be super complicated or high stakes. Thanks so much for watching. Keep diversifying, stay balanced, and I'll see you in the next video.